Let's talk crypto with design.
Hello and welcome designers. In today's video, we are going to talk about a major event that has shaken the US financial world in the past 2 days. The bankruptcy of the Silicon Valley Bank. Silicon Valley Bank, which is among the top 20 banks in the US, has gone bankrupt. On March 10th, according to the statement released by the FDIC, the California Department of Financial Protection and Innovation announced the closure of Silicon Valley Bank and appointed FDIC as the bankruptcy administrator. Silicon Valley Bank ranks among the top 20 banks in the United States and is the largest bank to announce its closure since the financial crisis in 2008. In this video, we will explore what led to the sudden bankruptcy of Silicon Valley Bank and what it means for the world's financial system. Before we get into what happened, it's important to have some context around how the bank operated and who their main clients were. Silicon Valley Bank is the bank that operated in the heart of technology industry in Silicon Valley, California. The bank's target clients were tech industries and startups and their founders. SVB had been an important part of the Silicon Valley ecosystem for decades, helping startups to grow and thrive by providing them with access to funding and banking services. We will try to break this down as simple as possible because, like all matters to do with the complexities of the banking system, it's not exactly straightforward. It starts between 2019 and 2021 when the bank's deposits increased significantly as the level of the venture capital funding exploded. In order to generate a return, SVB placed around $80 billion of the $189 billion in long-term mortgage-backed securities, which were reportedly paying a yield of 1.5%, leaving SVB with a healthy net interest margin. The bank bought a lot of long-duration bonds, which made them more sensitive to the interest rate changes. However, the mortgage bonds themselves were secure and the viabilities of these securities wasn't the issue. The problem arose when SVB had to face the liquidity crisis due to their clients looking to withdraw their money because of the uncertain economic conditions. The bank faced $80 billion of assets being held in securities that have fallen in value, and they needed to raise a cash, which made investors nervous. The announcement of a sale of a stock at a loss of $1.8 billion just days after crypto-focused bank Silvergate failed exacerbated the situation. Prominent VCs called their portfolio companies and a tidal wave of deposit holders withdrew their money. This created a liquidity crisis for SVB, which couldn't raise enough money to meet its obligations. Despite effort by the Federal Reserves and other banks to provide emergency funding, SVB failed to restore the trust among its customers and regulators. The collapse of SVB has sent shockwaves across the tech industry and the financial systems. Many startups are facing difficulties accessing credit or finding alternative lenders. Some venture capitalists are scrambling to protect their investments or exit their positions, and some crypto companies are facing legal challenges and regulatory scrutiny. In conclusion, the sudden collapse of Silicon Valley Bank served as a cautionary tale of the importance of effective risk management in the financial industry. The bank's decision to invest heavily in a long-term mortgage-backed securities proved to be a risky move, especially in the times of uncertain economic conditions and the rising interest rate. Additionally, the lack of effective communication with investors during the liquidity crisis further compounded the troubles of the bank. Going forward, financial institutions must prioritize risk management and transparency to ensure stability and maintain the trust of their clients and investors. We will keep you updated on this developing story as the more information becomes available. That's all from today's. Thank you for watching. Please subscribe to our channel for more tech news and analysis.